Hello there.
Hello everyone, thank you for coming. This week's theme is Buy the Dip, and we're taking a look at a house builder and a data analytics company. In our portfolios, one portfolio is taking the lead from another, so let's have a look and see what's happening over there. This is Battle 7, I'm the gentleman investor. Let's invest. As always, we're going to reveal who won the battle between last week's two stocks. We're going to take a look at our portfolios, and we're going to battle two stocks against each other. Without any further delay, let's get underway. The beverage companies battled it out last week. We've added up all the votes, and the winner was Nickel. It beat Fever Tree with 2 votes to none. Right, let's take a look at how our portfolios have done this week. By way of reminder, it's £75 divided into 3 and distributed between our 3 pies: the Battle Royale, where you tell me which stocks to invest in, the benchmark, where we compare how the Battle Royale is doing, and the income generator, which is making you money. So how are they doing? Let's find out. Let's start with the benchmark. As you can see, it's performed admirably over the last 7 days, particularly taking into account the fact that the UK market has gone down by 0.9%, whereas this has gone up by 0.8%, so very happy with that. And by way of reminder, we're invested in the VWRP, or the Vanguard FTSE All World. Let's see how the Battle Royale did. It's now up to 6 stocks, including Nichols, and that's one of the ones that over the last 7 days apparently performed the best. But our total return by the time we invested in it has allowed us to go down by 1.9%. Not ideal. Our grand savior, Evelyn Tesla, is now down 9.6% on the week. We're still up by 0.2%, but it's not propping up this portfolio like it was, unfortunately. So there is a lot of red on both sides of those columns. How did it perform? Badly. We're down 2.3%, and that is a lot worse than even the UK market has done at 0.9%. And considering I don't even want to look at what the US market has done, and we will be vastly outperforming that. According to Simply Wall Street's portfolio snowflake, this is a value portfolio and a solid dividend payer. I'm thinking, thank goodness we've got the dividends now, because our growth is not happening and we've lost out to the benchmark quite clearly there. Let's compare it to the final stock, the income generator. Over the last 7 days, it's also lost 0.04, doing slightly better than the UK market. But again, we're in that for the income, not the growth, so that's okay. The income generator, as you saw, performing all right on the whole. And if we take a look at the dividends, which is what we care about, we're now up to £4.65 annually. To remind you, we've got a total investment of 153 now, and that equates to the £4.65 over the year. Our next payment is 0.9 pence, and the payment after that is 0.82. So that gives us the next winnings, which we're going to pay out, is £1.72. Not a huge amount, but again, we build it up slowly, and I like to see those little towers getting bigger and bigger. And finally, the grand reveal. How have all of our portfolios performed? Last week there was a lot of green, with the Battle Royale performing comfortably above the benchmark, but this week, as you might have guessed, red, and well below the benchmark, which is now up 3.1% in total, whereas our Battle Royale down 0.69%. So I clearly need some help, guys. Please vote for whichever stocks you think I should be investing in rather, because I clearly need the help. Thank you.
3, 2, 1, fight.
This week's theme is Buy the Dip. Vistry Group, a UK house builder, has taken a staggering fall of almost 30% over the last month. That was down to a bad earnings report. YouGov, which is a data analytics company, has taken a massive fall of almost going on for 40%. That happened in June, and that was also down to a bad earnings report, which included a profit warning. So neither of these companies are doing well, and they have had some serious dips. So why on earth would we want to invest in either of these companies if they're doing so badly and the earnings forecasts are so terrible? Well, that is the question. The main answer is because they're cheaper, and the better answer is because I think they're still very good companies with solid fundamentals and decent future outlooks. If we're taking the long view, which I think we should all do as investors, that won't matter over the long time, and that makes this a great entry point and a good price level to be dipping our toes in the water. The question for you is, which one's the better investment? Let's take a look at both stocks and compare their high-level metrics. YouGov specializes in market research and opinion polling through online methods. The company's methodology involves obtaining responses from an invited group of internet users and then weighing these responses in line with demographic information. Vistry Group is somewhat simpler. It provides affordable mixed-tenure homes. It wants to add social value and leave a lasting legacy of places people love, according to their website. If you have a look at the underlying statistics for both companies, YouGov has a slightly higher PE ratio of 21.6, and that's even after the fall. So that shows you how difficult it was to enter into that company, and now might be the opportunity. Whereas Vistry is now trading at a PE of 13%, which I think is closer to what the UK standards would be and what similar companies in the sector trade for. The dividend yield for YouGov is 2%, and Vistry doesn't have a dividend yield, as you can see from the below. The other thing worth noting is that the earnings per share is 30 pence for YouGov and 65 pence for Vistry, so not a lot to choose between the two. To whip you through a very quick comparison of the two companies, according to Simply Wall Street, this is their executive summaries. As you can see, Simply Wall Street estimates that Vistry Group is trading at 77.9% below its fair value, whereas YouGov is trading at 65.9%. What is their estimate of fair value? Well, that's anybody's guess. I would take it with a pinch of salt, although it is interesting, and I would never rely too much on what the experts forecast, but however, any information is valuable. And that should be taken into account looking at the other metrics and fundamentals of the company. So looking at that alone, they think that Vistry is the better deal at the moment, but YouGov appears to be the better company with regards to how it can grow in the future. It's forecasting its earnings for YouGov to grow at 29.79%, whereas Vistry only 14.48%. They think that if you're looking at the Vistry Group, you need to be careful of a volatile share price. Well, yes, that's exactly why we're here. There is a bit of a dip, and for YouGov, they say that there's a high level of debt. Looking more closely into each of the two companies and having a look at their snowflakes that Simply Wall Street likes to do, Vistry has a decent health and history, and they think it's good value, but they're not so keen on its future, and obviously it doesn't pay a dividend, so that's not really coming into consideration. You can have a look at the further metrics, and recommend you should. It makes for very interesting reading. I'm more tempted by YouGov. Yes, the health and past aren't there according to them, but I think the fundamentals are still pretty good. They think the value is good, and most excitingly, I think it's got a very good future, as you can see on the snowflake here. According to Simply Wall Street, it passes 5 of their 6 checks, and of course it pays a dividend. It is not the be-all and end-all, particularly in this portfolio where we're looking at growth, but better to have than not, of course, particularly when your earnings per share are probably on a downward spiral, but hopefully that'll change in the future. And the other thing is that with the UK building industry, yes, Labour have made good noises towards that sector and improving things, but I want to see a little bit more growth and stability before we jump on any UK builders. So, all things considered, both companies seem to be a bit of a risk if we're being honest with ourselves. A bad earnings forecast is never a good thing, and a profit warning even worse. But I still think that these are good companies, and this could be a good entry-level point. The question is which one? I suggest we invest in YouGov. Please tell me if you agree with this or not. And can you think of any other companies that have had a bit of a tumble recently and that could be a good investment opportunity? I did take a look at CrowdStrike, and they were very tempting, but the scale of the potential future litigation just made me think that it wasn't even worth considering for the purposes of this video. Whether or not you agree with that, I'd love to hear about it in the comments. Please let me know. I hope you enjoyed this video. Thank you so much for watching. I look forward to seeing you next week.
Goodbye.